Markets are celebrating rate cuts that don't even exist yet, but what if Wall Street's optimism is setting us all up for disappointment? Tonight, we're going to go deeper beyond all of the headlines we keep seeing. We're going to go into the Fed politics, Nvidia's trillion-dollar run, tariffs with India, and a warning sign in the plumbing of the financial markets that almost nobody's talking about. But let's start off with the market snapshot with how the US indexes performed on the day. So today, US stocks inched up higher. The Dow Jones Industrial Average up 0.32%, the S&P 500 rose 0.24%, and the Nasdaq added 0.21%, a steady climb. But underneath the surface, the real story is what traders are betting on. And look at after hours at those two top charts are what we're really paying attention to with the S&P 500 and the Nasdaq 100. We see after hours, they tanked down a little bit, giving up all of the gains on the day. And we'll talk about all that went into that here in a bit. But let's talk about the Fed futures and rate cut expectations. So futures are now pricing in a higher percentage chance of rate cuts, being at 88.7% chance of a September Fed rate cut at their September 17th meeting. You could look at this for yourself. Look up CME Fed Watch tool on Google and you could find this exact website. But they're also pricing in, if we go out to December 10th's meeting, we're looking at a 48.6% chance that we fall between, and this is for the Fed's target rate. And they do it in like a range, right? The target range is 3.75% to 4%. So what that's pretty much saying is that they're expecting multiple cuts before the year end, with 4 cuts priced in over the next year if we go out even further. But this is where the issue is. Markets have been wrong before as to what to expect as to these rate cuts. In early 2024, futures priced the Fed slashing rates by about down to 3%. And instead, what we ended up seeing is that we're still sitting at this 4.25% rate. Up here at the top of the screen, you can see it right there. And weak job data last year really pushed futures even lower before reality forced traders to necessarily reset their expectations. As RBC strategist Jason Dahl warns, beware of the whipsaw in the Fed pricing. One strong jobs report and those bets will completely evaporate and say bye-bye to these Fed rate cut expectations that we're currently seeing right now. Now, this isn't just about the numbers, it's more so about the psychology of everything going on. For 2 years now, markets have been ready. They've been really waiting and addicted to this idea of cuts. It's making everybody like salivate thinking about it. Oh, lower rates, I can't wait. But history tells us the Fed rarely moves as fast as traders hope. Everything takes a little bit longer than we expect when you really look at reality. And then there's other factors coming in play as well, like the Fed's independence, which has been coming into question for quite a while. So politics has entered the chat. President Trump has attempted firing Fed Governor Lisa Cook. We've talked about this, and it's more than just a legal question. It's a test of the Fed's independence. Cook says she won't resign. She plans to sue, and the Fed itself says it will follow the courts. This is all old news, but here's why any of this matters at all. It's because if Fed is attempted and successfully taken over by Trump and it's reshaped the Fed board, he could assemble a voting majority that cuts rates faster than Powell wants and faster than, I guess, pretty much anybody's expecting right now. Right as people are starting to get used to, all right, it's going to take a little while, rates higher for longer. But that means the Fed, which is the most important central bank, the U.S. Federal Reserve Bank, could become an extension of the White House policy, which is no bueno. As one economist put it, undermining the Fed to get lower rates is now like ripping the batteries out of your smoke alarm because it keeps on beeping. Quiet for a moment until the fire starts. Wow, what an analogy. Now, there's this other problem that we're also facing between this man right here that we're looking at, Trump, and it's more so in tune with this One Big Beautiful Bill Act, the Tax and Spending Bill Act, which balloons U.S. debt from 37 trillion to 53 trillion about by 2035. More debt, more borrowing, and more pressure on inflation. So bond markets are already sending mixed signals as to what's going to happen out of this. We see short-term treasuries rally on Fed rate cut hopes, which is cool, right? But at the same time, when the Fed cuts rates, they don't necessarily impact the longer end of the curve, the longer term treasury bonds, which are selling off, pushing the 30-year yield close to 5%. And if we wanted to see this, what you could do is go to Google, well, who needs to even go to Google? Just go to cnbc.com. I'm loading in right now. We could do this together. Boom. And what we want to do is, here, let's go to markets. My computer will speed up for us. And we want to click bonds. And then once we're loaded in right here, we can see what I'm talking about. So we want these US Treasuries right here. Once we load up, and then go down to the US 30-year. And what we see is that the 30-year Treasury bond yield is at 4.916%. So very, very close to 5%. I was just telling somebody, if I won the lottery, what I would do with that 800 million or whatever it is, I just put it in 30-year treasuries and live off of the interest. That would be a phenomenal risk-free return. But if yields break that level again, stocks could face another correction just because these impact borrowing costs. And borrowing costs in terms of loans, and who borrows money? The government, businesses, and consumers like you and I, if you're catching my drift here. Because we got to borrow money. And when the cost of borrowing money is higher, rip, it sucks out there. But let's talk about Nvidia, because then there is Nvidia, and this one is one of the companies carrying the entire stock market. It's one of the most valuable. It is the most valuable company in the world, and it's one of the most important companies in terms of what happens to the stock market. So the company just posted a jaw-dropping $26.4 billion in net income earnings release, which is up 59% year over year. Revenue crushed expectations at 46.7 billion, but despite this monster quarter from Nvidia, which they've shown, shares ended up slipping after hours because data center sales, its crown jewel, missed Wall Street's sky high hopes by just 200 million. And when we're looking at these type of numbers, that's such a small drop in the bucket compared to the larger picture. And when we go back to the stock market, when we were looking at what happened in the after hours, that's why we've seen the market move the way it did in the after hours. And that tiny miss shows you the danger of lofty valuations, with Nvidia trading at a 34 times forward earnings, which is far above the NASDAQ average. So as long as profits keep climbing, the story just holds steady. Everything's nice and good and everybody's happy. But investors here are asking, is this AI boom limitless, or are we approaching a peak of expectations and is it just down from here? Meanwhile, tariffs are hitting. The tariff wars are back on the stage. The U.S. tariffs on Indian goods just doubled to 50%. We talked about this happening yesterday, a direct retaliation for India's purchase of Russian oil. Sectors like textiles, gyms, shrimp, and furniture will be hit hardest, threatening millions of jobs in India. Trump also threatened 200% tariffs on China rare earth exports, materials critical for these electric vehicles like Teslas and the defensive sector. And he's warning on new tariffs on countries that tax and regulate U.S. tech firms. Now, this isn't just trade policy, it's inflation policy, because tariffs mean higher consumer prices, complicating the Fed's rate cut calculus. But who cares? If Trump controls the Fed, cut rates, we're going to zero, baby. Now, liquidity risks are also coming into concern. So here's the underreported story nobody's really talking about. The Fed's overnight reverse repo facility, which once holding $2 trillion in excess cash, is nearly empty. Wow, how isn't this making headlines everywhere? The liquidity buffer has collapsed to under $50 billion. So if markets hit turbulence in September, and especially around the quarter end, which think about what we've revealed, what we found out about September. September is a crappy month for markets usually. So if this market has turbulence in September, and especially around the quarter end, we could see a replay of the 2019 repo crisis where short-term funding rates spiked to nearly 10% overnight. The Fed might need to step in with emergency liquidity once again. Now, this is the plumbing of the financial system, and when it clogs, everything else gets messy, and it's just a domino effect if we go from there. So what's the bigger picture? Stocks are climbing on rate cut euphoria, but the Fed independence is under threat. Nvidia's growth machine may not be invincible as what their earnings revealed today, and tariffs risk reigniting inflation, which is kind of messy from the Fed's point of view, but who cares when Trump controls the Federal Reserve? And beneath it all, liquidity buffers are running thin. So the market feels calm right now, but history tells us the calm before the storm is when investors let their guard down. This is why we dig deeper than just the headlines. We want to know what necessarily is going on. Rate cuts may or may not be coming, but the bigger story is whether the Fed can stay independent of the White House, whether AI can justify its hype with these huge sky-high numbers and expectations, and whether the financial system is prepared for shocks. So don't just watch the markets, don't just watch these press releases, understand the forces shaping it. I'll keep breaking it down every step of the way, and I will see you there, everybody. Hope you have a good one.